Hello, bosses. Welcome back to Boss Economic World. I'm your host, the guy who reads the Federal Reserve minutes so you don't have to suffer through the boredom, breaking down the financial matrix to show you where the money is hiding and where the bodies are buried. Today is December 17th, 2025. The holiday season is upon us. The malls are crowded, your crypto portfolio is probably doing something volatile, and the Federal Reserve? Well, the Federal Reserve is currently acting like a dysfunctional family at Thanksgiving dinner, screaming at each other while trying to pass the gravy. If you thought 2024 was confusing, 2025 has been a roller coaster designed by a sadist. We just had the December FOMC meeting last week, and let me tell you, the consensus is dead. The era of the polite, unanimous Fed is over. Today, we are diving deep into a bombshell dropped by the outgoing president of the Atlanta Fed, Raphael Bostic. This man is packing his bags, he's retiring in 2 months, and he has decided to use his senioritis to drop a truth bomb that Wall Street absolutely does not want to hear. The topic today, the Great Fed Civil War, why Raphael Bostic wants to freeze your rates until 2027. Buckle up, bosses. We're going to look at why your mortgage isn't getting cheaper, why the unemployment rate is lying to you, and why the Supercore Inflation monster is hiding under your bed. First, let's set the scene. Last week, December 9th to 10th, the Federal Reserve cut interest rates by 1/4 percentage point. That was the third cut of 2025. On the surface, that sounds great, right? Yay, cheap money is coming back. Wrong. If you look at the voting record, that meeting was a bloodbath. We had 3 dissents. In Fed speak, 3 dissents is equivalent to a fistfight in the parking lot. 1.2 regional presidents voted against the cut. They wanted to hold rates steady. They think inflation is still a dragon breathing down our necks. 2. Here is the data point that has everyone freaking out. The delayed November jobs report dropped yesterday, and it showed the unemployment rate ticking up to 4.6%. Now, for those of you who follow macroeconomics, you know about the SOM rule. It basically says that when the unemployment rate rises a certain amount above its recent low, we are already in a recession. At 4.6%, alarm bells should be ringing. Governor Miron sees 4.6% and thinks, the sky is falling, print money. But Bostic? Bostic looks at 4.6% and says, relax, it's structural. This is the crucial part, bosses. This is the difference between a cyclical recession and a structural shift. Bostic argues that companies aren't firing people because demand has collapsed. He argues they are firing people because 1. The post-pandemic hangover. Companies hired way too many people in 2021 and 2022. They are still trimming the fat. 2. The rise of the machines. We've been talking about AI for 3 years now. Bostic explicitly mentioned that firms are using technology to replace staff. This is a massive distinction. If unemployment is rising because nobody has money to buy stuff, you cut interest rates to stimulate the economy. But if unemployment is rising because an AI agent named Claude or GPT-6 can do the job of 3 junior analysts for $20 a month, lowering interest rates won't fix that. As Bostic put it, these are structural changes that cannot be addressed with interest rate adjustments. If the Fed cuts rates to fix AI unemployment, all they will do is pump more money into the system without creating jobs. And what happens when you have more money chasing the same amount of goods? You get inflation. On the other side, we had Governor Stephen Miron, who essentially flipped the table and screamed, we need to cut 50 basis points. He thinks the economy is crashing. And then there's Raphael Bostic. He wasn't a voter this year, but he just released an essay yesterday that essentially said, you guys are all crazy. If it were up to me, I wouldn't just hold rates today. I would keep them flat through the entirety of 2026. Let that sink in. The market is pricing in 2 cuts for next year. Bostic is saying, zero. Nada. Zilch. He wants to keep the boot on the economy's neck for another 18 to 24 months. Why? Is he a villain? Does he hate your stock portfolio? Or does he see something the algorithm-obsessed traders on Wall Street are missing? Speaking of inflation, let's talk about why Bostic is terrified. The headline numbers look okayish. But Bostic is looking at something called Supercore Services Inflation. This excludes housing, food, and energy. We are talking about the price of haircuts, medical care, car insurance, veterinary bills, and legal fees. Bostic warns that this supercore inflation is sticky. He sees inflation remaining above 2.5% even at the end of 2026. Why is this happening? We are in late 2025. Tariffs are back in style. Global trade is fragmenting. Supply chains are rewiring. Bostic notes that price pressures aren't just from tariffs, they are embedded in the service sector. Here is the terrifying logic. Service workers are scarce. Their wages go up. Companies pass those costs to you. You ask for a raise because your insurance went up. The cycle repeats. Bostic believes that if the Fed cuts rates now, they are pouring gasoline on those embers. He warns that if this lingers, the public and price setters will eventually doubt that the FOMC will hit the inflation target. Translation: once you stop believing the Fed can stop inflation, inflation becomes permanent. It's a confidence game, and Bostic thinks the Fed is blinking first. Bostic called the decision to cut rates last week a close call. That is Fed speak for "I think you guys made a mistake, but I'm too polite to say it directly." He pointed out that the median forecast before the unemployment data was only for one cut in 2026. The market wants 2 or 3. The gap between what Wall Street wants and what the Fed needs to do is widening. We are seeing a divergence that we haven't seen since the 1970s. You have one faction of the Fed terrified of a recession, and another faction terrified of entrenched inflation. When the central bank is this divided, volatility is guaranteed. The Fed put the idea that the Fed will always save the stock market is eroding. If Bostic is right, and rates stay flat through 2026, the current valuations in the stock market are, let's just say, optimistic. Now, we have to address the elephant in the room. Bostic announced last month he is retiring at the end of February. The timing is suspicious, isn't it? Regional Fed presidents serve 5-year terms. They have to be reappointed. The Board of Governors just voted unanimously to approve the other 11 bank presidents. Bostic? He's out. When asked if the scrutiny of the reappointment process played a role, Bostic gave the classic "it's not you, it's me" breakup line: "This decision was mine to make, and I made it on my own." Here is the Boss Economic World take on this. Bostic is a hawk in a dove's world. He has been preaching higher for longer while the political pressure has been screaming for cuts. When you know you are leaving, you can stop playing politics and start telling the truth. His final essay is his manifesto. He is basically saying, "I'm leaving, but don't say I didn't warn you." If you cut rates too fast to save the labor market, you are going to wake up in 2027 with 5% inflation and a destroyed currency. So, bosses, what do we do with this information? How do we navigate the Bostic scenario? 1. Don't bet the farm on cheap mortgages. If you are waiting for 3% mortgage rates to return in 2026, don't hold your breath. If Bostic is right, the long end of the yield curve is going to stay high. 2. Watch the Supercore, pay attention to your insurance premiums and service bills. That is your real inflation gauge, not the price of a flat-screen TV. If those keep going up, the Fed cannot cut rates aggressively. 3. Job security is king, with unemployment at 4.6% and rising, and structural displacement from tech. Cash flow is more important than asset appreciation right now. The companies right-sizing aren't done yet. 4. Market volatility, the market is pricing in cuts. Bostic says holds. When the market is wrong, corrections happen fast and hard. The economy is currently in a state of cognitive dissonance. We have recessionary unemployment numbers mixed with inflationary service costs. The Fed is fracturing because the old playbook doesn't work when the problem is structural rather than cyclical. Raphael Bostic might be walking out the door, but he just left a burning bag of reality on the Fed's front porch. He sees a world where 2026 is a grind: high rates, sticky prices, and a labor market in flux. Be smart, watch the data, not the headlines, and remember, in the world of economics, when everyone agrees, everyone is usually wrong. But when everyone disagrees, that's when you need to watch your wallet. This is Boss Economic World. Like, subscribe, and let me know in the comments, do you trust the hawk Bostic, or are you betting on the cuts? See you next time.